Bienvenue tout le monde.
So welcome everyone.
everybody. J'espère que vous êtes bien hydratés. Moi,
I
personnellement,
hope you are well hydrated. I'm drinking some sparkling water. I'm a fancy guy, but I'll keep that for the next session.
I get to pass on la parole. Pass the mic. That's how I say it in English. Look at me with my English. I get to pass the mic off to Dr. Olaf Weber, who is a professor and university research chair at the University of Waterloo, to start a conversation on financing for the SDGs. This panel features Andrea Dix, who's the president of Community Foundations Canada. Again, previous client of Future Ancestors. We love y'all. Nice to see Andrea. And Narinder Dhami, who is the executive lead and at New Power Labs and managing partner at Marigold Capital. Donc, Olaf, over to you.
Thanks a lot, Choke. This was great. I wish I could speak these two languages as well as you do. Thanks a lot. So, this the first hour of this afternoon, we talk about money and the need for money and probably the power of money as well. And I think, currently we have realized this, and, you see the news, climate finance is a big topic, nearly daily in the news since at least Glasgow, COP26 in Glasgow. Also recently with the really negative developments in Russia and Ukraine, we have seen, the discussion about SWIFT, how a change in the financial flows in the financial industry can change the whole economy as well, and how powerful this impact is, though it's very indirect. And so I want to introduce the topic a little bit at the beginning. And so I think, we know the SDGs, and without a doubt, financing will be needed to achieve the SDGs. And there are always these big numbers around, United Nations Conference on Trade and Development estimated an investment gap of $2.5 trillion. So overall, 5 to 7 trillion will be needed annually until 2030 to achieve the SDGs. A lot of money. The World Bank has an estimation that domestic governments might be able to provide between 50 and 80% of the funding of the SDGs. So some of the money comes from public funding and from governments, but we need private investments as well. On the other hand, this sounds like a lot of money, but if you look at some of the biggest institutional funds, such as Norwegian Sovereign Wealth Fund or California Public Employees Retirement System, they have assets about 1 trillion alone. So these are just the two big pension funds. And of course, they invest this money as well. The value of global financial assets is 290 trillion as well. That's a lot of money that can be invested. And there we see growth rates still, and we have growth rates over the last years, even during the pandemic, and we see still growth rates in that. And so compared to this figure, 5 to 7 trillion needed for the SDGs, it's kind of relative again. It's still a lot of money, but it doesn't look that big anymore, given that finance is channeled into the right direction. So I think financing the SDGs should be possible if there's a willingness to do so. So the question, however, remains, how can the SDGs attract private finance as well to government finance? And so that's probably some of the things that we can learn in this hour. And so let's start with a kind of a general introduction, and maybe I start with Andrea. So maybe help us set the scene for financing the SDGs in Canada. We know SDGs, that's often seen as the international development goals, but also it's also domestic in Canada. And so how does it look like? So where's money coming from? Who are players in the field, and how are the SDGs addressed in Canada?
Wonderful. Thank you so much. Hi, everyone. Thank you for the opportunity to be here today. I am in my home in Ottawa, which is the unceded unsurrendered territory of the Anishinaabe Algonquin Nation. And for those of you who might not be familiar with CFC, maybe I'll just take a moment to talk about the work that we do because it directly connects to the SDGs. And so our purpose is to relentlessly pursue a future where everyone belongs. And we do that by working alongside a network here in Canada of 200 community foundations, alongside Canadians and partners. And we do this work to make that future a reality that I spoke about. And so I want to start the conversation with where we are. It's March of 2022. I think we can all agree that 2020 and 2021 were underpinned with fast and furious learning curves, and that is still happening. The COVID-19 pandemic has shone a spotlight on existing inequities, and I think it's really important to acknowledge the existing factor of those inequities. COVID-19 has also tested the fabric of society. It has illustrated how deeply those communities who have already been experiencing vulnerability require more resources. And the pandemic has also sparked necessary shifts across all sectors, whether that's corporate Canada, government, academia, philanthropy, and more. And I really want to emphasize philanthropy because we are no different. The way in which we have been changed over the last 2 years, the way in which we have gone through those learning curves over the last 2 years is quite significant. And so the observations I'm going to share with you today are rooted in philanthropy and related to philanthropy and its connection to the SDGs, but I'm quite certain that there will be lots of parallels to the work that you do in your own spaces. We've been situated in the gap. We've been situated in the tremendous gap that we have to achieve the SDGs in the time horizon that has been set out. And I think that there's an assumption that perhaps we are making here in Canada, in that there are an abundance of resources available to achieve the SDGs. And so the issue right now in March of 2022 is not whether or not the money exists, but perhaps one of whether or not we are prioritizing where that money goes and how it flows. So more specifically, are we transforming the way that resources and power, because we should talk about power also, but transforming the way that resources flow. And so to dive into philanthropy a little bit, I want to talk about accountability. So in philanthropy, we have seen really good momentum with the adoption of the SDGs. Examples of this is using the SDGs as a measurement framework. So we saw recently in Winnipeg the Voluntary National Review, which was Canada's second, and that was a collaboration between philanthropy and the community. And so that is a way in which a large group of local and provincial collaborators, including the United Way, including the Winnipeg Foundation, they came together to create this and create a conversation about how Winnipeg is doing connected to the SDGs. We also have, in the network that I work with, we have many community foundations who utilize something that's called vital signs. And they have mapped their vital signs, which is Canada's largest community data program. They have mapped that to the SDGs. And so there are close to 100 community foundations across Canada and now globally who are doing vital signs, and many who have done this work. They're using the SDGs to understand their community's needs, to measure their impact, and to direct funding. So when we go back to what I said earlier about that flow of resources, we're seeing the SDGs as a way, and the conversation around them as a way in which those resources are starting to flow. The second piece that I just want to speak about is specific to financing. There are many foundations that support outcomes that can be mapped to the SDGs, whether they do it intentionally or not. That's an important nuance. But proactive grant making and investment is really limited to a handful of foundations right now when it comes to the SDGs. So to dive a little bit deeper into some examples where we're seeing this, where we are seeing people embed the SDGs in their work. So there are a growing number of community foundations who have created SDG-aligned granting streams. So if you're in Montreal, if you're in Victoria, if you're in London, those are examples where the community foundation has granting programs associated with the SDGs. This is good news, but we'd like to see more shift in this way so that the cumulative granting from all foundations between now and 2030 can be mapped towards those goals, can be mapped as to the contribution that they are making in the achievement of those goals. The other place where we really need to see connected to financing, where we really see opportunity, and I think where we really need to see more opportunity and more action, is in the investment practices. So just a little bit of history. Right now, there are more and more philanthropic organizations who are leaning into impact investing, social finance, mission-related investing quite seriously. And this is tremendous. At the same time, these are topics that we have been discussing for many years. And so the adoption, the taking an idea and putting it to action, moving it along that spectrum, in some cases is slow. So to use community foundations as an example, we are delighted that there are many in our network who have significant percentages of their endowed assets activated through responsible investing or social finance, more broadly, impact investing. There are several who are not. And so the work that we are trying to do is to bring that conversation forward so that we can unlock that potential for the invested assets to be doing good while being invested. So some background that's helpful is that in Canada, there is currently a regulation that requires foundations, whether they're community foundations, public or private foundations, but requires them to disperse a minimum of 3.5% of assets. And many do more than 3.5%, but 3.5% is that minimum. And that's 3.5% of more than $85 billion. That is a lot of money. That is a lot of opportunity. That is a lot of ways in which we could be investing towards the achievement of the SDGs. And so the potential to activate that other 96.5%, that's on the table. And that's for us to responsibly lean into and to see if we can't shift those dollars into spaces in which they are contributing to the achievement of the SDGs. Because imagine what would be possible. It doesn't quite fill the gap that you were talking about, Olaf, but I think it starts to get us there. So I'll pause there. I know, Narinder, you probably have lots to add.
Yeah, that's great. And you know, the figures I have thrown around are global. And so so that's a great contribution. So Narinder, from a you are representing an investor, so private investor. So from your point of view, so what is your view on SDG and financing the SDGs in Canada?
Yeah, no, thank you for that. And thank you, Andrea. So the two hats that I'm wearing today, just to give a bit more context, one is New Power Labs. It's a think do tank with actually CFC as one of our partners there. And it's about how do we build more equitable capital flows across all types of capital. So whether it's philanthropy, impact investing, venture capital, or traditional bank financing, the same communities that hold diversity are often excluded, whether that's gender diversity, ethnic diversity, disability diversity, ability diversity, sexual orientation, and so on. So New Power Labs is really looking at taking a research approach and a benchmarking tools approach of how do we actually shift the system through a movement of folks that hold assets and actually want to drive change. And then one of the other hats I wear is having a small impact investment fund called Marigold Capital. And we're invested in a few companies, and it's a gender lens and social equity lens investment fund. So, we pull and link directly to the SDGs in that front. But if I take a step back, and I think what Andrea was mapping was so great to lay the landscape of what our opportunity is. And when you think about SDGs and the goals, it's really helpful for folks who are trying to deploy their assets to understand how they can do it, what are some of the key needs of the broader global community, and how can different types of capital actually start to support the various goals. And I think a lot about the responsible investing umbrella. And so, there's different, there's a lot of, often we interchange a lot of the language within impact investing and ESG and screening. And so that entire space, I'll spend a few minutes walking through that, because I think each type of capital flow has a different type of opportunity to drive impact. And then I would add philanthropy as part of that as well. And so, so if we look at the umbrella, the side that's closest to more traditional finance would be ESG integration. And so that's when investors are taking into consideration ESG factors, so environment factors, social factors, and governance factors. And the way I see that is it's actually just good governance, it's good diligence, it's good strategy to take into those elements into consideration. And that's where a bulk of capital sits today, is in ESG integration. And so there is a report, I want to say it was Bloomberg had a report of there is $35 trillion sitting in kind of ESG, the broader space of ESG, and 25 trillion sits in ESG integration. Now, on the financial side, that kind of pillar of investment often does really well. On the impact side, there's just much more, the link isn't as tied to some of the things you can do in philanthropy or private markets. So I'll note that. And then you have social responsible investing. And often that takes a form of negative and positive screens, right? You might say you don't want to invest in dirty oil. You believe in this one, one of the climate goals, or you want to invest with female leaders, right? Thinking about the SDG that links into gender equity. That has, again, it's still most of that capital sits in the public market space. The impact has been, it's harder to measure the impact on that. So I think there's still a lot more research to try to figure out, are we truly moving the needle when we're working in socially responsible investing and in the negative positive screens. And then there's some really interesting stories coming out around or research coming out and journalists looking into some of the companies that fit into that space to question and to really, I think at this early stage of ESG investing, how do we become really good at it, and how do we eliminate some of that greenwashing that may be happening within that space? But there's still quite a bit of capital there, socially responsible investing. The part I get most excited about as it links to broader impact and the SDGs is really in the private markets, impact investing space, and in philanthropy. And so in the private market space, that this is our opportunity to say that, there are different types of businesses that are addressing SDGs in new ways, that are providing new products and services to communities that have been underserved. And we can actually build a new future by starting off and investing in new companies. So that's where, Marigold plays, but that's also where we've had, I think, the most data in terms of providing and addressing some of the SDG goals. And then philanthropy, and Andrea, I think, did a great job of describing the philanthropy space, is again another area where you see a tremendous amount of opportunity to start to address or continue to address the SDGs.
Yeah, thanks a lot. And I think it's really important, as you mentioned. We have ESG financing or integration. We have socially responsible investing. I always say, these are mainly, and that's, there are exceptions, but these are mainly activities to reduce financial risks and to kind of, I always say, to my students, to reduce the worst, not to finance something that is really bad. So this is big. And I think you mentioned that, there's a huge increase, and we probably will sooner or later, everybody will do that because it's just better investment strategy from a pure financial risk perspective. But as you mentioned as well, what is much smaller is the impact related investments. And so with that regard, the question, and maybe Andrea wants to, or Narinder can go for that, so what do we need to do to attract, let's say, conventional capital? Let's say if, we have pension funds in Canada that have a huge amount of money. And so what can we do to attract investors that are not necessarily impact investors like Marigold, but do their, have a certain goal to create the benefits, to create the income for the beneficiaries. So how can we attract them to invest in the SDGs? I don't know, Narinder or Andrea or whoever wants to respond.
I can weigh in on one thing. Something that I think a lot about, and I know there's been many conversations through philanthropy and in other spaces about this, and it's about motivation. And I think it's a way into your question. There's three spaces where motivation, a conversation of motivation is happening right now, specific to not necessarily specific to the SDGs in financing and investing, but specific to ESG or socially responsible, however we want to call it, or the different types. And so those motivations that show up in the conversations that I'm part of are institution driven. So the institution of philanthropy is intrigued, is interested, is wanting to lean into living its values through the way in which it invests, has conversations about that, and then makes a determination about what its strategy will be. I think we should come back to strategy, and we should come back specifically to the positive and negative screenings and the ways in which we're seeing a lot of uptake, but also the impact is potentially something that would be interesting to talk about. But institution driven, so it's coming from the center of the organization. Another space where there are many conversations are donor driven, and so in philanthropy, this is unique because you have individuals or families who have assets who are putting them into philanthropy and then working with the organization. And there will be many conversations that are happening now with the individuals to the philanthropic institution to say, well, how are you investing the assets that we are going to donate to you? How are you ensuring that your assets are doing good and in particular not doing harm towards the exact challenges that we are trying to solve through philanthropy? And so that's, I think, an important nuance and something that through, I would say, the last 5 years, there's been a notable shift in how those conversations are happening that is rooted in some cases in the demographic of the donor, but we're seeing more holistically that show up across the board. The other space that I think is really important to acknowledge is regulation driven. And so that as a motivation. And I think right now in some spaces, there is a fear that there will be a regulation driven required motivation to invest in a certain way. And I'm not worried about that in the sense of it doesn't scare me. I think that it is 2022, and if we are not investing our assets with a strategy that is deployed against our values, then perhaps we deserve to be regulated because it seems completely inconsistent to not do so. But there is many conversations that are happening within regulatory bodies, whether that's government or others, who are bringing forward a strategy, a conversation about strategy of investment and whether or not those assets are being deployed towards good, if we can label it that way. So I think that that's an important element to how we can get money to flow, because it comes back to a lot of motivation and whether or not that's your own motivation, your donor's motivation, or a regulatory body's motivation. That's a space in which I think we're going to see more and more show up and perhaps force some decisions to be made for those who aren't yet doing so.
So it would be in our own benefit to invest in
Sure.
SDGs. Yeah. Sure.
Yeah, of course.
Yeah.
Of course. And with the caveat to what Narinder was saying of, how are we building an investment strategy that ensures that we are actually making change towards the SDGs, as opposed to, a positive or negative screen is sometimes an investment in the least bad. And so how, Narinder will have more information about that than I do, but it's almost a false belief. If that's the case, are we actually investing in the SDGs, or are we just investing in it not getting worse? And so that's something that I think about a lot.
Thank you. So Narinder, do you want to add something to that? So how can we attract investors?
I'll build off that last point, because it's that clarity of what is impact. Is ESG integration impact? Is positive negative screens impact? Is it kind of, does impact investing sit in the private market space? And I think, and part of this is likely a function that how nascent we are as a sector and as a space, is that there's a lot of confusion on terminology, on language, on what is what. So I personally, my personal belief is public equities, ESG has limits in terms of impact potential. And I'll give two examples. So one is Philip Morris. Folks remember Philip Morris. It's a cigarette company. They sell 700 billion cigarettes annually. They're a well-rated ESG company as well. And they're on the Dow Jones Sustainability Index. So again, is that impact? And do investors who are investing in public ESG funds understand what's actually the group of companies that make up those funds? And linked to more recent events, the EU Bloomberg reported on this. The EU is now looking to see if weapons can be an ESG asset. So weapons as an ESG asset. So all of this makes me really nervous, because I think, again, we have this intentionality of the space has such potential, but when there is not clarity in what is impact and what isn't potentially impact, and that creates a lot more challenges. And I don't know, I always believe in a healthy skepticism. And so I think we need to apply that a bit more rigorously into the sector so we can get better. So in 10 years, our models are robust. We know where we're putting our capital is going to drive impact. So the first piece, my first recommendation would be that clarity in what is driving impact. Understanding if you're saying you're a 100% impact fund and 90% of your capital is sitting in public equities, impact might not be the way you should be framing how your assets are invested. So that's one. The second is risk perception. I still think that there is the understanding of the diversity of investments that you can have for impact and what their associated risk perception is. There's a lot of assumptions on what risk looks like. It really depends on industry. It really depends on the company. It really depends on all of these factors. And I think that there is often just an inclination to just broadly assume everything that's linked to impact and impact investing is high risk. And it isn't. There are some things that are high risk and some things that are less risky and are good risks. And then the third one, it touches actually back to Andrea's comments, is incentives and motivations. Like when I think about philanthropy and over $85 billion that sits in endowments and philanthropy, what happens when those are all unlocked for impact? And I would say private markets impact investing, because that's where you can see more transformation. But this is, and what is the risk for not doing it? And so I think that there is a really interesting space there. And then, what are the incentives to encourage more people to do it? And whether it's regulatory, Nova Scotia had a really interesting tax credit, I can't remember now, as many years ago, where they wanted to encourage local investments in Nova Scotia, and it worked. Nova Scotia saw a tremendous amount more investments across the province. So if we want more capital in the space, let's figure out what that incentive structure is. And maybe there's a tax credit linked to it, but incentive structure is to get capital in there. And maybe I'll add actually one more point. Again, I think as individuals, we are changing and shifting the way we buy, the way we consume, the way we live, with probably more acknowledgement of the broader social issues. But also as individuals, when we're thinking on the investing side, it's hard for retail investors. So unless you're accredited investor, it's really hard for retail investors to find products within private market impact investing. And so what can we do to remove some of those barriers so that more Canadians that are equipped to invest? I don't know what the Canadian stat is, but in the US stat, about 10% of the population are accredited investors and 90% are not. I believe that's the stat. So what happens when you unlock more investors to be engaged in the space?
Yeah, thanks a lot. And maybe I come back to I think it was your first argument. How do you know that something is impact? So what are the current system or indicators, or are there ways that, for instance, you can say, okay, this investment is impact. So maybe you can let us know what are ways to figure out whether an investment is impact or not?
So I think one of the challenges within the way a lot of ESG reporting is done is that it's mostly driven from the reporting of the companies. And so it's, I say I do X, Y, Z. And so then I'm going to evaluate you based on the X, Y, Z. We're not doing a lot of kind of broader, actually there's some startups that are looking at this, and it's getting better. But, if I am a clothing manufacturer and I have a company that is using slave labor, is that going to show up in my rating? How does that show up? How will folks know? And are we sophisticated enough on the way we evaluate to be able to identify that? And that's more on the, kind of some in some ways simpler things to identify that might be no risk. So for me, my first piece is the harm, like do no harm. Like we can't think of, if you do part of your business that creates a lot of harm and maybe part does good, we have this weird way to place those two things side by side. So I always, when I look at anything, whether it's, use Tom Shu's example of how problematic that organization is, but if you don't, I always apply the do no harm principle at the front. And then there's different ways, there's different tools that you can use to evaluate impact. And it depends again on what your thesis is. And this is where it becomes a little bit more complicated because most impact investors have a different thesis and they have, a different, investment view that if you do X, Y, Z, we're going to get to the end state. I think what gets me excited is that there are organizations and groups like the GIN, the Global Impact Investing Network, that support IRIS, measuring of outputs and outcomes. There is the 2X challenge. So as you think of more and more individuals recognizing the opportunity in gender lens investing, how do you know you're actually effective in gender lens investing? There is a framework out there that you can use to help you and advise you. I think broadly there's a lot of different ways in which, and there's a lot of different tools that you can use to understand and evaluate impact. But the piece I see most often left out of the conversation is the harm potential, the negative consequences of impact that might be happening.
The web address of the GIIN.org in the chat here. So for those that are interested. So Andrea, how do you, simple question, but probably not simple response. How do you measure the impact of your activities, investment activities?
I think Narinder has given a tremendous response. I'll share two things. One, I think that there has been progress on the conversation about the correlation between impact and returns. That's an important one to acknowledge. In that, 10 years ago, when we would talk about social finance, and we would talk about the philosophy of social finance, there was a lot of speculation that if you did social finance, you wouldn't have the same returns that you would if you were to invest in the traditional market or traditional means. And I think we've done a really good job, for the most part, of busting that myth, because that's certainly not the case. And yet it does come forward in some situations and in some conversations. And so there's an element that the way in which we are able to measure impact is connected to the way in which we measure returns, specific to social finance, in that we are doing both. And so the more that we can strengthen, as Narinder has spoken about, the ways in which we're able to talk about the impact, I think that will continue to help to bust the myth that's associated specifically with the financial return. The other element that is perhaps on the edge of your conversation or on the edge of your question, and that's connected to the holistic nature of the investors, the holistic nature, for me, of philanthropy and the institutions that we're working with. And so when we are talking about impact, and specifically impact towards the SDGs, what we're trying to do is take in the same way that the SDGs are an all of society opportunity, we're trying to take our investment in the practices or in the specific SDGs, we're trying to take our investment in those and situate them within the institutions. So it isn't just about how your finances are flowing, it's about the 17 SDGs and the ways in which they connect to your organization, from a governance standpoint, from operational, from the funding that you put out in the world, both through your investments and your grant making. And so there's a couple of examples that I can share where we are seeing tremendous effort and the embracing of the opportunity to change how we do our business, with the SDGs at the heart of that decision. And so one would be, there's something called the Canadian Philanthropic Commitment on Climate Change. And it's a statement that to date, 45 funders in Canada have signed on to, including CFC. And it outlines clear and straightforward steps to take climate action, so SDG 13, that is aligned with Indigenous rights. So funders commit to exploring resources not only through their grant making, but also through their investments, in addition to in-kind, in addition to their own pattern of behavior, whether it's associated with travel, whether it's associated with their physical space, et cetera. And so this type of strategy speaks to the intersection of the goals, and through the commitment on climate change, we're recognizing the intersection of all of the goals. And so specific to this one, we're thinking about and building in ways in which we are speaking to SDG number 5, gender equality, SDG 10, reducing inequalities. What's the correlation and connection to climate action and SDG 13, and how can we weave that into our own actions in addition to our investments? Another example, and one that I really love, and I think it's important to talk about this month in particular with International Women's Day next week, and that is something that's called the Equality Fund. And so the Equality Fund is an organization in which CFC is one of the very proud partners of. And it's an organization that is building a strategy for grant making, building a strategy for investments, building a strategy in terms of how they govern and how they operate, all towards gender equality and all towards SDG number 5. Where that shows up in our day-to-day world here in Community Foundations of Canada is a domestic program that's associated with that called Communities for Gender Equality, where we are working with a cohort of community foundations over a 2-year period that takes them through ways in which they can embed SDG number 5 and their commitment to SDG number 5 into their work. And so, yes, that is about changing their investment policy to ensure that they have a gender lens in their investment policy. It is about how they grant, who they grant to, ensuring that there's a gender lens associated with that. It is about their own institutional change in terms of the policies that they have for their staff, for their governance, whether that's connected to hiring practices, whether it's connected to parental leave, whether it's connected to pay equity, all of that is being woven in so that we're taking the SDGs and we're putting them into practice in ways that will be sustainable, in addition to ways that will be financial.
Thanks a lot. Yeah, that's very interesting. So maybe let's connect back to the to the different SDGs. Maybe a question for Narinder. What are the SDGs where we see impact investment, that are kind of more attractive, let's say like that? And what are the SDGs from your point of view where we need much more investment that is less addressed by, especially, private investment?
Yeah, that's a really great question. One area where you're seeing, I think, a lot, and just Andrea touched on this, is gender equity. Like, you're actually seeing a pretty bold movement on gender lens investing, not only in Canada but around the world. I'm on the board of an organization called CAFID, and it's an association of folks who are engaged in impact investing outside in countries outside of Canada, mostly developing and emerging markets. And we released a report last year. I think everything's merging still in a virtual sense, but last year. And we saw that one of the biggest trends in Canadian impact investors investing abroad was a tremendous increase in gender equity and gender lens investing. So I think we're seeing a lot of traction there. We're definitely seeing a lot of traction in climate action. And it's the risk perception in that is also different. So when you look at some of the large impact investment funds in Canada, ArcTurn or Renewal, these guys are on like Fund 3, Fund 4, and they've all kind of gone deep onto the climate action side. So you're seeing really good energy there, good health and well-being. There's a lot of opportunities and a lot of investments that are going in there in digitizing, in increasing access. Quality education, I would say, is very similar. You're seeing quite a bit of capital that's flowing there. And I would say affordable, number 7, affordable clean energy also links into the climate action. There's still other elements of this that, you see deep investment like clean water and sanitation. There's an impact investment fund that only focuses on sanitation around the world. So you're seeing some really specific and targeted investments. The piece that I spend a lot of time talking about, and I think we need to go a bit deeper into, is the part around reducing inequalities, and also thinking through, in all of these spectrums across all of the SDGs, who are we actually deploying capital to? And are the recipients of this capital actually reflective of the demographics of the communities that of those communities? And so I'll just share a few stats in Canada to give you a sense of at least the financing landscape. So 90% of deals by Canadian venture capital funds across the last 5 years went to teams that were founded exclusively by men. So 90% all men teams got all the venture capital in Canada. Black Canadians are least likely to report being able to access products from their primary financial institution. Women are getting about 3% of venture capital. Black founders get about 3% of venture capital. About 30 cents on $100 goes in philanthropy, goes to Black-led organizations. And what I think is, in many ways relevant, in particular the work Andrea and I are driving, is Canadian foundations almost exclusively invest in white or male fund managers, impact investment fund managers. So this access to capital piece, and even it's not just about the bottom of the pyramid access to capital, it's really about a global access to the capital. Who has a privilege to translate their ideas and their ambitions into programs and products and organizations? And that's a piece where I think we need much more intentionality. And this is some of the work we're doing in New Power Labs. How do we, make that more visible, and then help those that are in that journey to deploy their capital more equitably, help them with the right tools and support so they can do so. So that's where I spend most of my time thinking about. And I think is a huge opportunity, not only in Canada, but globally.
Yeah, thanks a lot.
sorry, could I give one more stat? In Africa, 90% of the impact investments done in Africa are investments done in expats. 10% are African entrepreneurs. So clearly some opportunity here for us to be a bit more inclusive.
Yeah, and maybe a follow-up question coming from the audience. So how is that related to risk assessment? So is it like, there are some SDGs we really need, to work on that, but it's too risky, or, do you see any connections there, or do you say disconnected, or is, what is the role of risk assessment?
It's a really good question. And how do we assess risk, and how do we make decisions, right? And I think what is very well documented now is that there is bias across the investment process. We prefer people and trust people who look like us and who sound like us, who are educated like us, right? And so then you think about who holds power and who are making the financing decisions. And then it doesn't take long to see that same demographic of folks who hold power and make financing decisions mirror the demographic of people who receive capital and are then enabled to do the work to address the SDGs. There's a study in Harvard that looked at men and women across the traditional venture investment process. And women were asked questions that were more liability type questions, right? Like, why are you going to fail? This won't and men were asked mostly asset-based questions, right? Like that amplified, what they were doing. And this was done giving the same pitch to a whole bunch of different investors to really be able to measure that delta. And, gives me optimism is we're recognizing that this bias exists. And the first step is the recognition. And then it's about how do we address it? And as folks that may come from diverse groups, whether we're women or people of color or other communities, then we just need to get better at changing the conversation, right? If you're asking me a liability type question, I'm going to answer your question and I'm going to pivot to the opportunity. And so, I think we're getting more aware of the challenges, and then we can actually start to address the unfortunate bias that exists across the system.
Thanks a lot. Yeah, that's a great response. So question for Andrea. So from your point of view, what are the SDGs we need more investment, philanthropy, whatever, money? And then maybe you can also elaborate on, has this changed now during the pandemic? So do we see a shift to different SDGs in Canada? But and so these are kind of two questions. But the first one, what is the focus now that we need?
Sure. Before I answer that, I just really want to emphasize Narinder's point about shifting who receives capital, how capital flows. And that's whether it's invested capital, whether it's grant making capital, like the types of capital that we do for our grants. But I think this is significant, and it's a point that we can't underscore enough. And it's something that I think COVID has helped us to hopefully shift significantly, because there has been a spotlight on how capital currently flows and the need for it to change into a flow that puts the decisions and the money into the individuals and the groups who are leading that work, who best know the needs of community. We talk about driven by community as being the most powerful form of change that is possible. And so that's an element that I think is important in our investment practices, in our grant making practices, in our hiring practices, in all of the different ways in which we connect to capital. In terms of your question of where is their funding lagging in the SDGs, or where are our opportunities? I don't think I have the information to specifically address that, but I do know that SDSN released a report in 2021 in which they revealed that Canada is only on track to meet one of the 17 goals, and that's quality education. So there's a ranking for the rest in terms of the type of significant challenges that they're facing. And I think it's important to note that 8 of the goals are facing significant or major challenges. And that includes gender equality, despite the investment increase that Narinder is mentioning. It includes climate action, life on land, and life below water. And so perhaps that's a signal that it might not be that we're not flowing the funding to the right SDGs. Perhaps it's a signal that we need additional capital to flow. So it's not necessarily about the time or the prioritization. It's about the actual amount that's going. And to be honest, I was very surprised when I learned it was only one. I think SDG 17, which is about partnerships, is one that I expected everyone to knock out of the park. And clearly we're not doing that. And so there's tremendous opportunity for, again, our actions in addition to our investments to be put on the table here if we are truly going to move towards the achievement of the SDGs in Canada.
Yeah, thanks a lot. It's interesting to hear, kind of unexpected as well. So, is there any change over the last 2 years because of the pandemic in regard to the needs of different SDGs?
I mean, I don't have the math done or the evidence. I can give my perspective. I think that through the pandemic, the conversation around the SDGs, at least from a philanthropic funding perspective, existed, but we were in such a state of emergency response that really took over the main spotlight. And so when we think about this moment now of March 2022, where hopefully we are moving into a different era where the pandemic is hopefully leaving, there's an opportunity to recalibrate and reassess where we are at when it comes to the SDGs in Canada, both in terms, again, of our achievement or lack of achievement, and in terms of how we're investing, because we're seeing some of that emergency response funding that has been tremendous, that has come from corporate Canada, from government, from philanthropy, from private investors, which is amazing. We're seeing that begin to pivot into a more future-oriented space. And that's where I think we have an opportunity with the SDGs to bring them back into the center of the conversation.
So yeah, Narinder, from a private investor perspective, do you see, pandemic, financing, capital needs during the pandemic and SDG, do you see this going hand in hand, in line? Is it contradictory? Do we not as the hypothesis, we do some harm if you just pour money into all the businesses to save the businesses, then it might be negative for whatever, climate change or something. So do you see a connection between both SDG and pandemic financing?
Well, one of the things I've seen across a lot of in conversations with other fund managers was that a lot of the companies that were targeting the SDGs were more resilient across the journey of the pandemic. We saw this in our small portfolio. I think there's greater awareness coming out of the last 2 years on the needs. And I agree with Andrea. I don't think there's sufficient capital that exists today across the spectrum. I think private markets, impact investing tends to hover in certain areas of comfort still. And there's been a small but encouraging movement on the private market side to understand that there's other ways and other investments that are needed to build a world that is livable and is equitable. And so I think there is that shift of recognition. I don't know if I've seen this huge shift of capital yet in the impact space, but what you are seeing huge shifts of, and I've never seen this before, is shifts of capital to new fund managers. And this is more in the traditional venture space, is the diversity of fund managers that are mostly in the US, who have been able to actually create a new path forward to support new types of businesses, new organizations, some addressing some of these, some not, but that is encouraging. And I think the more we're aware that, number 10, reducing inequalities is actually, we're going in the opposite direction. Hopefully that encourages more and more folks to figure out how we apply capital into these areas. I see the biggest risk is greenwashing and the performative side of this work. And that's where my healthy skepticism comes in. But the opportunity, if we do this right, is tremendous and can really, combining that private capital and the philanthropic and public capital can truly address the large needs that we have across the world.
Thank you. And so we have a few minutes left. So maybe a final question to both of you, kind of, if you had a wish. So what would you see? What would you like to see? In the next, you have how many years? 8 years until we want to achieve the SDGs. So what do you want to see? From a financial perspective. So what would you like to see over the next 8 years? Maybe Andrea, you want to start first?
Sure. I think there's two things that perhaps I'll share, and one is a repeat because it just deserves to be repeated multiple times. I think we need to build momentum around intentionally centering new voices in the investments, in the decision making, if we are going to be successful. And so that speaks to what Narinder was saying earlier, what I was saying earlier about putting the decisions into the hands of those who haven't been given the opportunity to make those decisions yet. And the other thing that I'm hopeful for, that I think about, that we talk a lot about here at CFC, is a shift from incremental transactional approaches to change to those that are interconnected and transformational. And I think the SDGs give us a platform to do that. Again, it's about ourselves in addition to the financial resources. And so I'm hopeful, because I see sparks of that happening already. I'm hopeful that will continue and it will continue to grow.
Thanks a lot. So, Narinder.
I'm hopeful that we have better data. Everything Andrea said, plus just better data, increased accountability. How do we know if we're making a difference? How do we know if different communities are getting access to capital? How do we have, there's a lot of data in this world, but we don't always, in particular in Canada, collect disaggregated data, or if we collect it, we don't really share it. And so there's some real deep opportunities in creating more transparency, and as a result, I think more accountability in how capital flows and how we start to address these big issues. And maybe the second area would be just, we're all on a journey, and sometimes as Canadians we get stuck because we're good people doing good work. And as good people, we cannot be racist, we cannot be sexist, we cannot have bias, we cannot have all these things. And there's a social psychologist in New York, Dr. Dolly Chung, who talks about this binary approach to good and bad is actually a very dangerous approach because it prevents us from getting better. And her view is, if we can all embrace the stance of being good-ish, so we can actually improve, we can recognize that there's always areas for us to do better, to do more, and to build greater equity. I think we could do much more. And as Canadians, again, as good Canadians, I also feel like this is a very appropriate mindset to adopt so that we can truly drive the change that we hope to see.
Thanks a lot. I think that was great, Andrea and Narinder. So I think we learned a lot about, what do we need and where are we already with regard to financing the SDGs. And in a way, I like, you both said, we need new voices, we need new approaches, we need new people in the field. And I think this is also a call for all participants here, everybody who is interested in SDGs. And I think, I'm probably, I'm 20, 30 years in the field of kind of socially responsible investing and similar things. So what I find really interesting is that now it becomes interesting to people that are really interested in international development, in sustainability, in SDGs. If you go back 10, 15 years, finance wasn't really the attractive thing to do. You know, it was rather help on the ground or something like that. And I think this is really positive, you know, that we see, okay, there's new voices. And I think we can see that there are already new voices in the field and working there and change the finance landscapes as well. I think this was were great insights from both of you. Thanks a lot again. And I think we have to finish now. And I go back to Chuck. Is that right?
Merci. It is indeed right. We are back to me. Hi, welcome back. Non, en effet, merci beaucoup Olaf, Andrea et Narinder. Vraiment, c'était une belle
discussion. Thank you so much, Andrea and Narinder. In Canada, often we do not broach the topic of money. It's a taboo topic. So it's nice to have a better understanding of money and funding. This was a rich conversation, absolutely necessary. Absolutely necessary. Where does money come from? That was so interesting. You talked about the ethical impact of funding and the use of money. It's very important to consider those aspects. You've also mentioned that we have to change the conversation, change the narrative, and that everything has to be transformed in the way we transit money. And it's not just good and bad. There's facts to be recognized. Even if we would like the best, we are human beings and we have prejudices and biases that can influence our behavior. If you remember, well, at the beginning of this conference, I talked about questioning your mode of functioning and how to welcome new knowledge. And I think this really resonated with me in your talk. Thank you very much.